Welcome to Market Call. I'm Morella Fernandez. Thanks for joining us today. Nick Mersch on the show. He's a portfolio manager at Purpose Investments. He'll take your questions today on technology stocks. Here's how to reach us. Call us toll free, 1-855-326-6266. If you want to email your question in, you can do that. Marketcall at bnnbloomberg.ca. Thanks for coming in.
Thanks so much for having me.
We have seen investors selling off some of the big tech over the past week, 3.5% down for NVIDIA. I think Meta's about down the same. What is your take on why they are doing this?
Yeah, and I think a lot of this was some air coming out of the system. And if you looked at the multiple expansions over the last little while, we had some of these crazy trading at very crazy valuations. So if you take Palantir, for example, this is a stock going over 70 times EV to revenue. Even though it does have a premium in terms of its growth rate right now and its profitability in the marketplace, you do have to pause a little bit and say, okay, some of these valuations have to come back down to earth. But I still do think we have a lot of fundamental growth ahead of us, and you're going to get some opportunities here over the next little while to pick away at these names.
I was going to say, would you be buying in at this point? And if so, where would you be putting your money in those tech stocks specifically?
Yeah, so I think what you really need to do is take this approach where you want to look at the entire stack of all these companies together. So you have the hyperscalers, you got the Amazons, the Googles, the Microsofts. Then you got the semiconductors, obviously NVIDIA, a company of the moment, but you also have memory components like the Microns. Then you've got the supporting infrastructure. So whether it's the Vertiv, the Equinix, the Dell, the Digital Realty, then you also have the power component because these data centers need a lot of power. So you have Vistra, you have Talon, you have Constellation in those areas. So I think across the stack, what you need to do here is really look for dislocations where you have these massive sell-offs. And you can have a lot more air come out of the market when it does come to the multiples. As you've seen Palantir down, for example, 20%, I think, in the last week. You will get opportunities to pick some of these long-term growers with very strong fundamentals as they do sell off and the multiples compress.
Okay, you touched on this, but again, investors are worried about the comparisons to the dot-com bubble and, as you mentioned, things being sort of overvalued. So how would you counter that?
Yeah, so I think when you look at the dot-com bubble, this was a different build-out. We were funding it very much with debt, and a lot of these companies were taking on aggressive debt profiles and having very high interest payments when it comes to servicing this debt as they built out this fiber optic network. But this build-out on this time around, we have these companies amongst the hyperscalers that are extremely free cash flow generative. So they've enjoyed decades of monopoly-like businesses to really have some strong cash balance sheets to do this. So a lot of this is getting funded with cash. And on the other side, we're also starting to see a lot of the revenue come up. And we can dig into this a little bit more, but on the cost structure, they're also starting to optimize. So what we're seeing here is a lot of operating leverage as these companies really roll these solutions out. What they're also doing is eating their own cooking. These companies are implementing a lot of these AI programs and applications internally within their own ecosystems. That's giving a lot more operating leverage as well.
Yeah, it makes your head spin because it affects, as you say, across the board, not just one part of the company, not just one part of our life. So there's so much to dig into. Okay, we're going to take a quick break. We'll line up some phone calls for you, get some emails in as well. Nick Mersch, Purpose Investments, taking your questions on technology stocks. Here again is how to reach us. We're back in a moment. Welcome back. Nick Mersch with us today to take your questions. We will start with an email from Rocky. Rocky says, hi, may I have your guest opinion on ServiceNow? So they're a cloud computing platform. Do you know much about them?
Yeah, for sure. So ServiceNow is a ITSM, so IT service management platform. And what they're very integrated in is the entire IT department of a lot of these Fortune 500 companies. And this has been one of those companies that has been a free cash flow compounder for a very, very long time, returning a lot of capital to shareholders, reinvesting that in growth, and really powering that forward. And where this comes in is really getting to know the ins and outs of how exactly the digital transformation is being powered. And what you have here is they're implementing a lot of these AI solutions at these companies because they're going in and saying, okay, if you need to do an IT service ticket, let's figure out a way to optimize that. So what that frees up is a lot more people working on these different solutions within them with a lot more time instead of focusing on just answering tickets all the time. And what they're doing now is really, they're at this intersection of a very interesting time because AI is coming in and disrupting a lot of software. ServiceNow is actually one of the companies that is benefiting from it because they're so integrated into the company's workflows. And you have to have a platform, you have to be integrated into these workflows, and you have to have distribution. ServiceNow has all these aspects. So I think even though the stock is down on a year-to-date basis, as people try to figure out where they fit in the AI disruption, I think ServiceNow is an enabler rather than getting disrupted by this new technology.
Yeah, we'll talk a bit more about software in its role moving ahead a little bit later in the show, but we hope that helps out Rocky. Let's go to Anita. She's calling from Markham, Ontario. Hi, Anita.
Good afternoon. Thank you so much for taking my call. My question is on Constellation Software. Could I have your opinion on this? Is this a sudden drop in price an opportunity to buy or stay away from it? And Mirella, would you have a street consensus on this, please? Thank you.
Okay, so Constellation Software currently up at 43.76. Let's talk. They're a software holding company, so we might have to sort of discuss now what we were going to discuss later more in full, but where does Constellation Software land in the AI space moving forward?
That's right. And Constellation Software is one of those companies that has grown through serial acquisition. So they're very aggressive in terms of the M&A strategy, and they're some of the best capital allocators in the business. So within their internal models, what they do is they look at internal rates of return for the individual software companies that they can roll in. And what they do is they go into the back end on the cost structure, and they really optimize that cost section of it to increase the margins on the bottom line. But what ends up struggling is they don't necessarily invest on the growth side. And what we're seeing amongst some of these companies that are consolidators in the space is that organic revenue is struggling over the last couple of quarters. We've seen this with OpenText as well, also a serial acquirer in the M&A space. And what we have to figure out here is how long is this organic growth going to be this muted? And what they need to have is a much better strategy in terms of getting back to that reacceleration of the growth, because if they don't drive that forward, you've got definitely reason to be concerned. But at the same time, what they do is they focus on specific verticals and they can get some synergies. So what I would look for Constellation Software for the number one thing is reacceleration of organic revenue rather than just the M&A revenue growth.
So what would be organic revenue for them? Because clearly they've been driving it by mergers and acquisitions, right?
Yeah, so organic revenue growth is just growth on the individual company kind of level. And the companies that they acquire are typically more in the SMB and kind of smaller space, although they have moved a little bit more up market. And over the 2021 period, this was a time when interest rates were low, so much capital was flowing into the environment. What they had to do to compete on some of these deals was lower their IRR hurdle rate. So they acquired some of these companies that might not look attractive in the longer term, and you got to see if that gets back to growth. And what that growth means is those companies starting to sign up a lot more customers, starting to increase the customer base and grow that revenue out, but then also right-sizing their cost structures as well.
Got it. Okay, let's move on to Jacob, who's calling from Toronto. Hi, Jacob.
Hi, good afternoon to both of you. It's a beautiful day, and I'd like to ask your guest about Shopify, please. I have some of it. I just want to know if I have to add to it or not. I'm just afraid about the earning. It's too high. Thank you very much, and have a good afternoon.
Thank you very much. Shopify down in August, although it reported earnings and did pretty well. This company is using AI internally, as well as offering it, I guess, to their customers as well, which seems like a bonus on each side. Why is it flagging, first of all, do you think?
Yeah, so I think this company has just been fantastic, and it's so great to see one of these companies, homegrown out of Canada, reach such a massive scale on a global basis. And you want to kind of go back to the 2021 period, and that's when everything shifted online very, very quickly here. Again, we had a lower rate environment and crazy multiples. I heard a couple analysts say, hey, look, Shopify's trading at 72 times EV to revenue, but don't worry, the revenue growth rate's so large that it can grow into this multiple. And when you hear that, some alarm bells start to go off. And the stock was trading around, I think, 160 into that period in 2021 and got as low as $25 or $30 in the 2022 period. So it absolutely sold off, absolutely right-sized, as you can see in this chart here. And what happened here was everything got brought online overnight, and Shopify was powering a lot of this. But what's going on right now is we're seeing the internet fundamentally be reorganized in real time, because you don't have these search machines anymore, you have these answer machines. So when people are going in and they're typing in a query into ChatGPT, where's that directing the traffic after that in order to buy these products? And for the Shopify, my point is it doesn't matter. It doesn't matter if it comes in from Google. It doesn't matter if it comes in from ChatGPT. What matters is that they are powering the back end and the merchant system behind it, which is incredibly valuable. They put up a really, really good quarter recently. They're right-sizing the cost structure. And this is another company that, instead of fighting against these trends that we're seeing in this new age of the internet, they're integrating with it. They've built in connectors and relationships with ChatGPT and all these other large language models in terms of their search platforms, and really integrating with it rather than getting swallowed by it. And
as you mentioned, does it really matter who directs them to the platform? It's the platform that Shopify will benefit from.
That's right. It's all about the merchants, and they're a staple in that category.
Got it. Okay, let's get to one more email question from Margaret. She says, could I get the guest's opinion on OpenText after its earnings and the ousting of their CEO? Ousting of their CEO was kind of surprising and very sudden. Berenche is gone. What's your take on OpenText moving forward?
Yeah, so this is a similar company to Constellation in terms of the information management platform that they have. And information management is really just about aggregating a lot of these different data sources, because there's this famous saying in software engineering and data security and data analysis is that garbage in, garbage out. So you really need to have your data house in order to really optimize a lot of the decision-making processes that you need to have. Now, OpenText is another one of these companies where you have to look at this organic revenue growth. If you look at their earnings on a year-over-year basis, they're still shrinking. So that's why a company like this trades at very, very low multiples, because you have to see a turnaround in the fundamental business here. And M&A is not a strategy in terms of M&Aing your way out of this, if I could say that. And the ousting of the CEO, I mean, we've seen this across the board. The CEO there, Berenche Mark, was absolute phenomenal when it comes to rolling up a lot of these companies over that time period and really leveraging a lot of the synergies between them. But what we see now is this new kind of order in terms of, okay, on the back end, can we have these systems and these applications that are being built from a very, very low developer cost? Can small companies do this at a much smaller cost, therefore eliminating some of the need for some of this software? I don't know. No, we're not quite sure yet, because some of these smaller companies don't have the time for it. It's not their core competency. So we'll see where it goes. But what I would watch for here again is this organic revenue decline that's concerning.
Got it. Okay, we're going to take a quick break. We will be back to take more of your questions on technology stocks in a moment. Welcome back. We are going to take an email now from Fred. He says, is Vertiv Holdings a buy or hold, and why? We'll pull up that chart in just a second. They are a holding company. They do power systems. Is this a company that you like moving forward? They're down a little bit over the summer as well.
Yeah, so Vertiv is really capitalizing on the opportunity of this data center build out. And what they do is the cooling systems behind this. Because when you see NVIDIA come out with all these new GPU models on the iterations, they've sped up the cadence into around 18 months now in terms of their upgrade cycle. Each one requires a lot more power, which means a lot more heat. When you're in these data centers, they are very, very hot if you ever got the chance to go take a tour. And what you need is to cool these systems down to optimal temperatures so that the GPU can have a much higher utilization rate. So this is the chips just being much more efficient within the data center. And when you I was walking the floor at GTC in the Bay Area, which is NVIDIA's developer conference, and they have these very intricate systems. And you can see all these tubes, these wirings, these pipes, and essentially they do the liquid cooling component of this infrastructure build out. Now, I'm always a huge fan of spotting these long-term secular trends and then investing in the companies that can sell the picks and shovels to this. And this is exactly where Vertiv is. So as we still expand our data center infrastructure out, We're seeing more and more. I think Sam Altman came out and he said he's going to spend $1 trillion on infrastructure. I think he said that last week. So we're still in, we'll call it the 4th to 5th inning of this infrastructure build out, because the CapEx numbers are moving up, and this all means more and more facilities for the data center front, and Vertiv is supplying the cooling structure. So for a data center, you have the land, the building, the supporting infrastructure, which is the racking, the cooling systems, and then the chips, the GPUs on the NVIDIA front. So there's still a massive opportunity here for Vertiv, and it will trade at those lower multiples because their margins are a little bit smaller and their growth is a little bit less than NVIDIA's. But in terms of the best pure play in the cooling side of it, some people are also playing Siemens or other kind of manufacturing equipment companies. But Vertiv, the percentage of revenue exposure that they have to the data center system is the highest out of anyone. So it's the best pure play from a kind of manufacturing component perspective within the data center space.
So if you have it, hold it.
That's right.
Got it. Let's move on to Linda from Edmonton. Hi, Linda.
Oh, good morning. My question is on Apple. I had bought it recently at a lower price, thinking that it was a good short-term opportunity. I also own it in Berkshire, and just wondering, what do you think about Apple for maybe medium to long-term hold? Should I sell it?
So do you have the same concerns about AI strategy with Apple that others do?
So Apple famously sat out the CapEx when it comes to this. So you're looking at all these other companies that are buying hundreds of billions of dollars when it comes to these data centers and this infrastructure that they're building out. And what they're doing is depleting their cash balances significantly. Apple sat this out. And in time, I think we'll still tell whether this was a good move or not. Because the argument could be made that a lot of these large language models, which require hundreds of billions of dollars to build up and to train, is that efficient use of capital at the end of the day when we when we figure out the revenue and the margins and the unit economics of these businesses? And by Apple sitting this out, they really stuck core to their concept of providing a lot of free cash flow. And if you look at one of these best charts that I like to look at is there's the share count of Apple over time. And the share count of Apple over time has decreased because they consistently buy back a lot of their shares themselves, which really enhances the return to shareholders at the end of the day. But then the question becomes, is this a strong capital allocation strategy? Because could they have been spending it on AI infrastructure as well? But at the end of the day, when you think about all this AI stuff, Apple owns the end consumer. And even though they came out with one, maybe two products that are absolute smash hits, the iPhone and maybe the iPods as well, the AirPods as well. I think AirPods revenue is higher than Netflix's. But by controlling the end user, you're going to have a lot of interesting things that you can do here in terms of still having that end user and the platform. So I would say, even though they sat out a lot of the heavy spend, they stuck very true to their free cash flow generative and earnings-based nature. Don't count Apple out yet when it comes to the AI strategy.
Let me ask you about the large language models and those who are investing in them. There are so many now. Is it quite possible or likely some of them will fall off the grid or get, acquired? I don't know if they would get acquired. I mean, is there a point to a merger and acquisition in this space, or will some of them just really fall off the grid because they're not getting used and growing the way others are?
Yeah, that's right. And on the large language model front, so what these are is I consider the operating system of artificial intelligence. And there's a couple key players in this space. So OpenAI, Anthropic, Cohere right here local in Canada is also a player in this space, Mistral over in France. And then we also got DeepSeek out of China, which was this open source model that everybody was freaking out over a while ago because they said they could do it much cheaper. But what we're going to see is a lot of these partnering with these hyperscalers. Okay. And just like OpenAI partnered with Microsoft in that regards, it gave them access to a lot more GPUs and a lot more capital. And I think OpenAI is a generational company of this time, and they keep putting out more and more advancements in this area. So when they came out with their GPT-5 model a while ago, some people were very, very excited about it, others not. And the people that weren't were in the developer community because they wanted to fine-tune which model they used in which situation. But what GPT-5 did was bring reasoning to the masses. And what reasoning requires is a lot more inference. So there's two parts of building these models. One is on the training side, which is very, very heavy upfront cost. The other is on inference, so running these models and making sure that they can think through these problems. GPT-5 was the first one where really shift a lot of the use cases towards inference because a lot more people were using it. Sam Altman tweeted, he made the joke that his GPUs are melting as soon as he updated the model sort of thing. And the API calls doubled overnight, which is all, to me, so API calls just meaning that anytime you call the model, it's the connector that's built into the system. And to me, what that looks like is just a lot more increase in some of these cloud usage platforms as well.
Got it. Okay, let's go back to the phone lines. Faisal on the line today. He has a question about CoreWeave. Hi, Faisal.
Hi, Mirella. Thank you for taking my call. Nick, welcome on your inaugural visit to the chair. Are you by any chance related to Frank Mersch? My question is on CoreWeave. It has sold off and the lockup period has expired. Would you be a buyer of it at this point? And for your viewers, Frank was a legend in the investment industry. Thank you. I'll hang up and listen.
Okay, thank you for the question. So CoreWeave at 92.15, so minus 14% over the last 3 months. What's your take on CoreWeave?
Yeah, so I think CoreWeave really is one of the most contentious stocks in the market right now because people are trying to figure out whether this is very sustainable on a go-forward basis because of their debt balance. So CoreWeave, what they really had was this very strong relationship with NVIDIA where they got preferential access to their GPUs ahead of everybody else. When Jensen was essentially sitting down on a Tuesday and deciding who to allocate to, CoreWeave was at the top of the order for this. And so what happened here was OpenAI needed a lot of compute in order to run these models, and it wasn't very sufficient to do that only on the Microsoft servers. So what they did was they went out to CoreWeave and they said they signed a large agreement, a large contract. I think it's around $12 billion, and they just added $4 billion as of the most recent quarter in terms of the revenue side of it. So you see these use cases in terms of they're benefiting from this moment in time where we have a drastic undersupply of GPUs in order to power these systems. But how long is that undersupply going to last, and how really proprietary is what CoreWeave's doing is a big question. They do have some pretty interesting tech when it comes to the bare metal capabilities in terms of optimizing the individual units of compute within the data center. But what people are concerned about here is the capital structure. So if you look at their debt profile, about $11 billion here. They've got 2030 senior notes, revolving credit line, 2024 term loan. And if you go to their interest and debt servicing, the interest in the first half of the year was $531 million. And in comparison, their operating cash flow over that period was $190 million. So these guys are setting cash on fire in terms of what they're going out and doing. They have to make sure the unit economics work over the longer term, and that's why I think the jury is out. They really have to figure that out, because every time an NVIDIA GPU comes out, it's 30 times better at inference and 40 times better at training in terms of how much better these chips are getting at, and they've pushed up the product cycle. So they're putting these things out every about 1.5, 2 years now. So how quickly is the depreciation working on that? So when you're looking through CoreWeave's financials, there's this EBITDA metric, but the depreciation aspect there doesn't make that metric very, very valuable to me. So I'd be looking at their free cash flow instead.
Got it. Okay. We hope that helps you out. Faisal, we're going to take a quick break. Nick is a new guest to Market Call, so no past picks for him. But we're going to talk about software a little bit more and find out the future of software companies in general. Back in a moment. Welcome back. Nick doesn't have past picks. He's a first-time guest here on Market Call. So we are going to talk a little bit more about the future of AI. And one of the big questions in the field is, will AI be the death of software? You say yes, but let's take a step back and talk about the kinds of software you think are going to be obsolete given AI.
Yeah, that's right. So I think there was a seminal paper a while ago that said software is eating the world, penned by Mark Andreessen. And now people are asking, is AI going to eat software? And there's a case to be made that if you look at a lot of these individual point solutions, they're going to absolutely get decimated, but there's power in the infrastructure and the platform companies still. So if you look at a company called LivePerson, as soon as this ChatGPT came out, this company got crushed. It was down about 98%. And what they did was automating call centers. So immediately what you saw was these very low hanging fruits in terms of what was going after, what AI was going after, get picked off quickly, and these companies just fall off overnight. Another one was one of these educational technology companies, because now you could talk to a live tutor in real time with feedback one-on-one, and and these companies got absolutely crushed. Now, what the market's still trying to figure out is what's going to happen to a company like Salesforce. And this is a very interesting intersection of it, because Salesforce has just been an absolute behemoth in the space. And if you look at just how much they've expanded on, we'll call it not great software in terms of it's just very expensive user interface, in my opinion, because you've got to train somebody 6, 7, or 8 months to get onto this platform. And the data lives in this little bit of a silo that doesn't necessarily get called all the time. And the co-CEO, Brett Taylor, he recently, well, not so recently, maybe over a year ago, left and started a company called Sierra. And what he's trying to do is really attack this with sort of an AI-first principle. And that's what we're starting to see. And I also think the revenue models have to really strongly adjust and adapt to this new normal. Because what enterprise software typically sells on is a SaaS model, and they do this on a per seat basis. But when you go into a lot of these companies, they have fewer and fewer software engineers, so that's fewer and fewer seats that you can sell into. And so if you're doing these per seat pricing models, you have to shift to some sort of consumption model. And Salesforce is trying to do that in terms of their, they had a per conversation metric in pricing behind that, but everybody was up in arms, so they've readjusted that pricing model since. But what we need to see here is a lot of these companies take this with an AI-first approach in terms of building it. Another area of software that I do really like is the infrastructure side of it. So everything that's powering the back end behind the scenes. Because as you get the proliferation of a lot of these agents coming into the market, they're going across all the web and they're crawling it. So you need to protect these different nodes. You need to be able to handle traffic in a different way, and everything is getting reorganized. So for the question of is software dead, I would say software as it exists today should be dead soon, because you can build a lot of these by yourself and just sort of mock something up, but you still need the back end to support it. You still need the infrastructure to support it. So these companies just need to adjust and adapt to this new normal by either reimagining fundamentally how these companies are, their DNA, but also their business models as well.
Got it. Okay, we do have to leave the conversation there for this part. We're going to take some more phone calls and emails in a moment. Nick Mersch of Purpose Investments taking your questions on technology stocks. Back in a moment. Welcome back. Let's go to Sal on the line in Vancouver with a question today. Hi, Sal.
Hi there. Yeah, my question is on Oracle. I was wondering, given that, based on the past segment, you guys were talking about AI and how it has impacts on software, and potentially the hardware side of things might still be okay. Where do you see Oracle fitting in on this, given that it does have the back end as one of its product lines? Thanks so much.
Yeah, so great question based on the conversation we had. And you said Oracle is actually pivoting.
Yeah, that's right. And I think everybody thinks about Oracle as kind of this legacy database and really having these kind of slow growth kind of, we'll call it very old kind of technology is the way that it was kind of perceived for a while. But what they're really doing is they're slowly emerging as this alternative player in the cloud industry. And when you have the Microsoft, so Microsoft's cloud product is Azure, Google's is GCP, and Amazon has AWS. And what Oracle is emerging as is sort of this next player in this ecosystem. And they're doing this through a big and flashy way. So what they did was this massive Stargate project that I think is going to be incredibly exciting to see how it really evolves. And this is a partnership with OpenAI, SoftBank, and it includes this $500 billion infrastructure push. So if you want to look at a cloud player that is starting to do a lot more in terms of leveraging their traditional kind of more on-prem database legacy kind of know-how, and now they're shifting aggressively in towards this cloud opportunity, there's a really good opportunity here because of the base rates. So if you're looking at some of these massive companies with these cloud revenues in the close to $100 billion or over $100 billion if you're AWS kind of run rates, Oracle has a much lower base right now. So it's really exciting because they're going to have this entire kind of revenue acceleration opportunity, specifically in the cloud side of it. And I think there's just a lot of kind of green side ups.
So they'll make more money doing it because of what they already have set up.
Yeah, that's right.
Got it. Okay. Let's go to Bill, who's in Bowmanville, Ontario. He's got a question today. Hi, Bill.
Thank you for taking my call. I'd like your guest thoughts on Vistra, VST. Does he see good things ahead? Thank you.
Thank you. Can you tell me about Vistra?
Yeah, so Vistra is really on the power and the energy side of this. And if you looked over last year, it was the #1 performing stock on the S&P 500. Next to Palantir, because Palantir had sort of that gangbuster movement, and it's doing pretty phenomenally well again this year. And what this is a play on is that we need more power into these systems, because when you look at the power requirement for data centers as a total of U.S. electricity demand, it's going from 5% of total to 12% of total. So what we need here is a massive injection on the power side of this. And Vistra specifically works on really interesting area in Texas, and a lot of the Texas kind of grid opportunities right now is where data centers are starting to gravitate towards. So it used to be the kind of data center alley in North Virginia because they had access to very sort of friendly regulation, very cheap power, and very good kind of labor there in terms of building these facilities out. But now we're seeing a kind of big push in the Texas area. And what we really need to power these systems is a lot of gas in the interim. So people are opening the arms and are really deregulating on the nuclear front, but these facilities take a long time to stand up, and you need nat gas in between them. I've been to some of these data centers, and they have these massive natural gas turbines that are powering them because you can stand them up quicker. It is a cleaner sort of bridge energy until we figure out more on nuclear. But I also sort of read this piece a couple of weeks ago that instead of bridge energy, this could be where it's heading for a long time here. And that's right.
Okay.
And that's exactly where Vistra plays.
Got it. Okay. So, and you see that, do you agree that it'll be sort of natural gas for the next maybe decade until some of these smaller reactors get built? Because those reactors, as you mentioned, take a number of years to put up.
Yeah, that's right. And if you look at kind of the nuclear capacity and nuclear ability of the United States, it has drastically lagged other peers. China is putting more and more online. Germany's going the wrong way in terms of taking them offline. Korea can build these massive ones in very, very quick time periods and for much cheaper. And when you compare the U.S.'s ability in order to build a nuclear facility, if you look at Vogtle, it was 4 times over budget and about 2 times longer than they had originally anticipated. Now we'll see if the kind of red tape getting cut around regulatory kind of action and prohibiting it to get built out, we'll see if that goes away. But in the interim, you're going to need this gas for sure.
Okay, let's go back to the phone lines. Jason is on the line today. He's got a question about Alphabet. Hi, Jason. What's your question?
Thank you. Nick, I'm looking forward to hearing your positive views on Alphabet. I'll hang up and listen to your response.
You're assuming he has a positive view on Alphabet, which I assume he does too. But what is your take on Alphabet?
Yeah, this is a really fun one, especially right now, because as I had alluded to earlier, the whole move from search engines to these answer engines.
And for a while, people were thinking, okay, that is it for Google, right?
Yeah.
Nobody's going to Google things anymore. They're going to go straight to a search engine. Are you seeing that beginning to happen?
Well, so there's kind of 2 sides of this tale. And what happened with Google here over a while is that Eddie Q from Apple came out during a lot of these, when he testified for the antitrust on the Apple side. And he said for the first time ever, we saw a drop in volume in terms of Safari visits on the pages. So people started freaking out and saying, hey, look, is search kind of as we know it dead? But what you look at Google and you go, look, this company invented the transformer. So there's a seminal paper out on artificial intelligence called Attention is All You Need, and Google authored that paper. So they have some of the best scientists in the world working on this problem. And yeah, there is going to be some short-term cannibalization because they have that AI overview along the top of the headline whenever you search something right now. But what you need to focus on here is that the types of queries that go in. So if I want to learn how uranium and we need uranium and nuclear energy are going to be powering a lot of these data centers, I'll do a deep dive kind of search on like ChatGPT. But if I need new shin pads or a hockey stick, I'm going to go on Google or something else to kind of find a vendor for that. So what's happening here with the search volume is it is changing in intent. So you have the visits that are going in towards Google have much more commercial intent. And then on top of that, you've got YouTube, which is an absolute beast. They're starting to take over living rooms. They're saying on TV, YouTube is taking up way much more time of individuals' entertainment consumption right now, and video is just exploding. So this is an incredible business.
Why do you think that is, that YouTube is exploding, considering how many streaming platforms and everything else are out there? What are people going to YouTube for?
Yeah, I think that have all graduated towards this kind of short form video kind of consumption right now. Because if you look at a lot of these other programs like TikTok, and now we've got kind of the Instagram Reels, which is a massive business upon itself, everybody is really craving this kind of attention or entertainment, in these video formats. And Google, specifically with YouTube, has been doing a great job of these. And what they've done is they've also powered their algorithms on the back-end recommendation engine through their shorts in order of just kind of having that kind of high scroll through and high consumption rate of it. And what you want to also look out for, though, is that when we looked at Fortnite and what Epic and the whole kind of video craze back then, Fortnite said our major competitor is Netflix because you're vying for individual attention at any given time. And now, since we've had this explosion in video, I would argue that you've got to watch out for ChatGPT, because people are spending more time as entertainment walking through and talking with these AI programs saying, hey, I want to have a choose your own adventure kind of platform and story game, and here's the loose outlines, and I also want to chat to this bot. Interesting things to think of down the line.
That just sort of warps my brain as we go along. Okay, Nick is sticking around, of course, take more of your phone calls and your questions in a moment. Stay tuned. Welcome back. Let's go to an email from Michael. He is looking for a comment on Ethereum prices. What is your expectation in the short term is what he wants to know, Nick.
Yeah, for sure. And this is a key player in the crypto ecosystem. And what we've seen here is a really strong momentum in the crypto space. So the first aspect of this is really re-regulation. So notice how I didn't say deregulation. Mm-hmm. So for the re-regulation of this space, what we're seeing is that previously under the Gensler's SEC, a lot of these very antiquated systems were applied in terms of governing this overall industry. So what happened before was that you could make a meme coin of a cat and it would be completely legal. But you couldn't, for instance, create a cryptocurrency that created a trading platform for renewable energy where I'm charging solar here and then I'm deploying it here in compensation for that. That was completely illegal because it provided utility case. So what we're seeing now is these entire new acts come to light. So one was the Genius Act, one was the Clarity Act, one on stable coins, and then the other on whether a cryptocurrency is considered a security or not. So we're seeing these re-regulation of this entire industry see a lot of very interesting stuff come to light. Now, when it comes to Ethereum specifically, I like to think of it as the software of cryptocurrencies. So what we have is Bitcoin is kind of that digital gold. Ethereum is that software. And what they do is they program these smart contracts. So say I wanted to take my dog out for a walk and I had kind of RFID, like one of those chips on it that I could just tap. So what this would do, it could guarantee, okay, the dog walker came, picked up my dog, it went and took it for a walk, it walked 5 miles, and then it came back, and then through that, I could pay the dog walker for that service. So all of these can be done through one sort of smart contract, and that's the essential kind of core concept behind Ethereum. So what we're seeing here is a lot of these kind of flows come to the market. We're also seeing institutionalization of the asset class. So we've seen the ETF flows really explode in terms of the US guys coming to market, even though we were first to purpose. But we're seeing this institutionalization of the asset class. We're seeing more kind of crypto on balance sheets at companies, and I think we're still getting started in this crypto wave.
Got it. Okay, let's go on to Phil. He's calling from Vernon, BC. Hi, Phil.
Flows really explode in terms of the U.S.
Phil, are you there? Okay, we may have lost Phil. His question today was about Meta. I'm going to assume he just wants the way forward for Meta.
Sorry?
He's looking at the way forward and sort of what, how it's employing AI, what it's going to look like in the future.
Yeah, and Meta is a really interesting one here as well, because all the headlines have just been how all in Zuckerberg is on this. So what's he doing right now is he's WhatsApping AI engineers at all the top shops, and he's paying them these sort of athlete-sized contracts. So he talked to a 24-year-old engineer and just signed him for $250 million over 4 years. That was the same size as Steph Curry's deal in the NBA. So he's absolutely all in on this, and he is betting the farm on it. And what he's doing here is really getting the top scientists in the field to work on it, and he's paying them these massive contracts. But if you ask him, he says, look, if I can spend a couple $100 million on these AI researchers here and there, But on the other side, I'm spending tens of billions on the CapEx. I might as well have the smartest people working on the best problem. And what Meta has done originally is they implemented a lot of this technology in-house to optimize their advertising platform. So there's this key metric in the advertising industry called return on advertising spend. And if you think about just all the users across all the different family of apps at Facebook, optimizing the return for these is great. And then you also think about it from a comparative perspective, because if Google search volume is dropping off, where else are people going to consume content?
Yeah.
They're going to Facebook, they're going to Instagram, they're going to monetize WhatsApp later. But what's happening here is that they're eating their own cooking, they're optimizing that, and they're having incredibly strong free cash flow from that business in order to fund it. And they're taking the approach completely differently. They're going open source. Now, what that means is they're giving developers a lot of buy-in into this ecosystem. So if you remember back a while ago, Steve Ballmer was on stage kind of freaking out, getting excited, screaming developers, developers, developers. The new champion for developers is Zuck, and he's trying to build this all open source to kind of lessen the power of these open AI systems and then get the developer community really building behind it. So huge bet here, much bigger than this whole changing his names to Meta and this whole metaverse thing, which we'll see if it works out or not. The glasses are pretty cool, at least. But huge bet on the AI front.
Yeah, I feel like the glasses, nobody's really picked up quite just yet. And even the metaverse, are they still spending a lot of money on that?
Yeah, so the whole name change to me was a little curious, and this is when everybody was kind of obsessed with Fortnite and had Travis Scott concerts on Fortnite, and people were spending more time in that digital ecosystem than they were in real life because everything was shut down over COVID, and then they changed their name to Meta, which is they should change their name to kind of AI, something AI based instead. But the glasses opportunity, I think, is extremely attractive because although the Ray-Bans, when you look at the unit volumes, it's nowhere kind of these Apple numbers. Really interesting uptake in terms of they're cool, they're fashionable, people like them, people use them. They actually got in their hands because this VR AR thing has been around for decades, but nobody's really got it right. So we'll see where Zuck can go from here in terms of implementing this, because people are still trying to figure out how they're going to consume AI. Is it going to be on your phone? Is it going to be through your glasses that are always on, recording every conversation, optimizing your meeting schedules, bringing up notes when you meet somebody? So having an always-on device is going to be a massive market, and whoever wins that is going to really win.
Got it.
Big.
All right. We do have to leave it there for the phone calls and the emails, but we have top picks from Nick when we come back. Join us tomorrow, Market Call. We'll have Brian Madden on the show. He's Chief Investment Officer at First Avenue Investment Council. He'll take your questions on North American equities. Nick Mersch with us today as a first-time guest on Market Call. He's got top picks, and we're going to start with Cloudflare on the New York Stock Exchange. So this is a software company, but as you were telling us earlier, they are an infrastructure software company. So can you explain a little bit about what they do and why you think there's growth in this company? Yeah, exactly. And I really love this infrastructure place because it's powering a lot of the backbone of this next AI revolution. And Cloudflare started off as what's called a CDN, a content delivery network. So essentially what happens is you have to send a lot of these packets over a lot of these cloud platforms anytime you visit a website. So at one point, Cloudflare was responsible for approximately 20% of websites' total traffic. And if you think about just the amazing problem that they had over the COVID period when everything got brought online, they had to pivot and completely put everything into this and say, hey, look, we need to solve this problem. Because what you have are a lot of these actors coming onto the system that can perform these malicious attacks where they flood websites and crash it. And if you're going to crash a website, for an e-commerce company, that means you're going to miss a sale. For a booking company, they could just go to Expedia instead of Booking.com. So you have a lot of these very intricate plumbing behind the scenes that makes the internet work, and that's exactly what Cloudflare does. Now, what they're also doing is starting to push a lot more towards the edge and then also work on the AI front. So when they came out and they said, look, you're seeing some of these large media companies like New York Times, they're able to negotiate a contract with OpenAI for $10 million for a licensing fee. But if you're a smaller media outlet or even an individual content producer, AI is going to come, scrape your data, put it into their models, you don't get paid. But with Cloudflare, they sit on top of that, and they're the traffic kind of intermediary. So they can say, hey, wait, look, we're going to be able to monetize this. So they're coming out, they're very vocal about this, and I think there's a massive AI play here, and it's going to be exciting. Got it. Okay, let's get to your second pick. Microsoft, very well-known company, of course, one of the top Mag 7. What do you like about Microsoft moving forward? Yeah, look, if 5 years ago, if you could ask me what company would I own for the next 10 years, I'd say Microsoft, and today the answer is still Microsoft. Because I think when you look at their partnership that they formed with OpenAI, which I think is the most consequential company of our time, they did that early. And they really were pioneers in terms of the first eras of compute. Then they moved into the cloud, and they totally missed the mobile, but now they're totally ahead on the AI front. So they invested about $13 billion when it comes to OpenAI a couple years, well, probably about 3 or 4 years ago now, in terms of getting ahead of it. And by having this partnership, what they had was these IP licensing agreements. They shared a lot of know-how. They deployed the tech very well. And when you think about Microsoft, it is an absolute beast when it comes to distribution. So they have very wide-reaching tentacles across every Fortune 500 company, and they're the path of least resistance when it comes to adopting AI, because they have a security platform. They've got your Office 365 suite. They have every single application from a business perspective already. Why not add AI onto that with their Copilot, which, by the way, is powered by ChatGPT, to really push that forward? Makes everything easy for everybody already on the platform. Okay, we have to get to your next pick, which is a classic NVIDIA. We've talked about it being down a little bit today. You think investors are worried about valuation, but moving forward, there's a lot of growth here. Yeah, and NVIDIA is just such a wonderful company, and what Jensen here is doing is really stacking these S-curves on top of each other. So every time he has a new chip, it is 30 times better in inference, and I think I said 40, I mean, it's probably closer to 20 times better in training, and the software on top of that, the CUDA platform, has a lot of lock-in for the existing software developers on that platform. So what you're doing is you're marrying the hardware and the software and having these massive improvements in terms of pushing the product cycle forward. The AI would not exist if it wasn't for NVIDIA, because we didn't have the hardware there. And now we do, and now we're finding all sorts of these applications. Now, these CapEx cycles do end. So I do want to say that it's not going to be the honeymoon period forever here. But at the end of the day, I think, look, we're only in the, I would say, 4th to 5th inning, because CapEx numbers were too low. If you look at 2024, CapEx spend across the hyperscalers was up 58%. In 2025, it was projected to be up 50% before this quarter, but everybody moves their numbers up, and now it's expected to grow 70%. So there's much more growth here, I think, in the CapEx front. We're still underbuilt, we're still under supply. AI is still taking off in terms of what we're figuring out, how we can use it, and I think it's really exciting here. Earnings coming up, I think they're going to beat and raise again. And all 3 of these are in your portfolio fund? That's right. Got it. Okay, Nick, thanks for joining us. Good to have you on as our first-time guest. I'm sure you'll be welcome back. And thank you for joining us here on Market Call today. We'll see you again tomorrow. A look at the markets as we head out to a break.